Welcome to Trading Lounge and the gold silver report for the 26th of March, and this is a silver chart here. It's a quarterly chart, so each bar is 1 quarter, and the reason for showing this is quite simply that we have in this space here we have this bar where it's trading lower than it opened on higher volume than the previous bar. So that just tells us that sellers are in control at this point, or simply not enough buyers there. So if we look at go from the quarterly and get a bit more detail on this, we'll see a slightly different story here. We'll see that over these weeks that have been going on through here, we can see that the volume's diminishing through here. So we can see that the sellers are drying up. So any selling that was done from the futures market would have been, in these highs up through, well, into this one. There were 7,000 contracts on this one here, pushing those WSB boys back down, and they would have repegged it second time here as well on that. But they're not there at the moment, so they're happy with the price being under that current scenario there. But it just goes to show that that the volume to the downside is diminishing at this particular point here, but we're not seeing any buyers come in and push it up at that point. The other point here too is that if we're counting this up as 1 and 2 here and 3 here, we can put wave 4 there, and why couldn't we put wave 5 on the top here? I mean, SLV and Sprock and all those guys, I mean, those ETFs, they're all the same as well. They've got that high in place there. I don't think it's the case, though, because we really need to line it up with gold in that regard as well. But anyway, just shooting the breeze. So what we can see here is we know that there's all the sellers are sitting up the top up here. They don't want it to go any further at that point. They're not coming into the play at this point, but we're not really seeing any buyers come in at this stage here as well. So a bit of a rock and a hard place with all of this, but we know that the $25 is the current support for this market, which is a medium level. And these two orange lines here, they are just the major levels, and the medium level always goes halfway between two major levels, so that's where that's playing out at the moment. So you could imagine that if that's the support there and the $25 becomes the retested resistance, then we're going to see more bearish moves come into play at that point. We'll see this move lower. I mean, I do think gold's under a lot of pressure. It's hard to start to justify a move up for gold. Not impossible, but the patterns are looking more bearish than bullish, which we'll look at in a moment. So this is the daily chart here for this, and with that in mind, this is the bearish count for that market. So instead of calling that a wave 5 top, we're looking at it as an A and a B and a C wave up here for that. I mean, technically, I'd rather put wave B top over here for this, because even when you look at SLV and some of the other ETFs and that, they've just got this one bar, which is a spike up here, because otherwise it should really be counted as 1 and 2 here, and this would be a third wave in here. It's just that it's extended here, and this being the 4th wave here and the 5th wave here for that. So, we just need to be a little bit mindful when we do these things. I know a lot of people will bag me for this, but putting the wave B there in that regard, because when you think about it, most of the traffic was really in this particular structure here. It was just that we had that manipulation there come into play. So anyway, it won't matter right now, but later on it could matter. So I'll just leave that there and dull it out a little bit, so it's not a primary sort of issue, but it's just something in the background at that point. Otherwise, we can look at this as it's a little bit, if we did use that as a top there, then we need to use that as wave 1 here and wave 2 here and wave 3 here and 4 here and down for wave 5. So in a bit of a nutshell, we could actually have that sequence completed at that point there as well. But whichever way I look at it, it's a bit of a long shot, and it's too long to bet on, so to speak, in that regard. So we're still going to have to just wait and see if gold pushes to the upside, and if that case, well, then we can move into the silver market. And if we were going to move in there, then we would want to see that 25 as a nice solid support at that point. I'm going to cut through from the daily chart to somewhere in here, the hourly. I don't know if it's been updated or anything, but yeah, this is another way to look. This is the more bearish way to look at this here, with all of this here as an A, B, C here for a W, and an X and a Y here for that, and then seeing an impulse wave down. If that's the case, then we can expect to see a rally here. So we'll just need to be mindful of this 5 waves down here, looking at a 50-60% retracement level here, and basically topping there and moving down lower at that point. So we need to be a little bit careful about thinking how far silver's got to go at this point. So we really need to see silver, you know, sort of above the $26 to be able to really confirm something. So I'm not going to call a trade in here. I'm not going to trade this up here. It's possible, and it could take us further to the upside, but we'd really need gold to take us in that journey. So we'll just take a look at gold here for a moment. I'll just start on the daily chart here. Now, with gold, we've got a bullish count and a bearish count. Well, in fact, I've got two bearish counts. There's this one here where we've got wave B here. We're looking for 1 and 2, and down for 3, 4, and 5 here. So 2 more legs down to finish this off here. And I can, even though we've got bearish counts and bullish counts for this, and I know that you don't like that, and that's all a little bit confusing, but I can make it really simple for you. And the simplicity is that, and we'll go through the counts, right, the different counts, so you've got an idea there. But the bottom line is, if this market's going to be bullish, we're going to need the 17,500 as the support. Okay, and we're also going to need, on that support, we're going to need to see a nice classic trading levels pattern or a variation of that. So coming up to the 1750, reacting from it, having the first high above the level, which becomes our reference point, the ABC pattern, and then finding support over here. Laborious, but that's how it migrates from being resistance to support. The variation on this is where it doesn't come back down below the level here, and that would be this move here for that. But that top here and the second top is where we go long from, but we need that reference point top there, because that's where it can fail at that point and not come back. So that's what you need. So the 1750 as support is the long trade, and on the downside is the 1700s, the closest largest number. But because we use the trading levels, we can look at group 1 of 1700, which would be 17, 10, 20, and 30. Now, the important thing is with that 10, 20, and 30 is the 20, the number 2. So if we see the number 2 here, which is the 1720, as the retested resistance there, what's going to happen at that 1720 point is the market, if that becomes the retested resistance, then the market's going to be pulled down to the 1700. And if it's going to be pulled down to the 1700, then it's probably pulling down too far at that point and would give a bearish note to the pattern at that point. This move up through here can certainly be counted as a wave 4, as a corrective pattern, and if it was going to be a bullish pattern, then we'd have to look at it, as mentioned before, a leading diagonal triangle. I think which would, well, this is just another way to look at it, which is not that crash hot, by the way, but wave 1 and 2 here, and then wave 1 here, and then an A wave here, because it's in 5 waves, an A and a B wave over here, and a C wave here for that. But it doesn't really matter. You still need 1750 to prove that's correct at that point. And we can just go in and have a look at this. Well, that's just the bearish pattern here as an A and a B and a C here, or WXY here as a wave 4, and would need that just to drop there. So the C that's sitting on the 1720, that's that would also be roughly the 61.8% from that low to that high here. So breaching that, or finding that as the retested resistance, is going to pull it back to the 1700, and in that case it pull it down further at that point. And that's a nice size for a wave 4 too, because if we look at wave 2 here, which was sharp and simple, then we can expect wave 4 to be sideways and complicated, and that's what it is at that point. But we can just keep drilling in here and having a look at different patterns for this. So this would be the leading diagonal triangle, and it's getting a bit long in the tooth now, but I'll give it the benefit of the doubt because that's in 5 waves here. So in fact, this one over here, we could look at it as a see, but wouldn't work. That would work better in that regard for that. But we do need that to push up from there. And let's just say that it does push up here. That will give us our first high above the level in 5 waves. And then we'll be looking at an ABC pattern here anyway, and then pushing up from that point. So that would be the leading diagonal triangle, but it's not looking like a triangle anymore, you know. So you just need to be very careful about that. So the cutoff point for you would be the 1720 here as a retested resistance. Another way to look at that too is, well, it's the best way to place the stops anyway. So what you would see here, if you're currently long in this market, the market would come down to here, bounce off here, probably shoot down to the 5, so the 17.5 here, and then if it was going to push up, it would push up from that point. So that low becomes the place where you can short or put your stop at that point, because it would breach at that point. But if that becomes the retested resistance here, then you know that the probabilities are to the downside at that point. I don't think we can really add much more to this except, yeah, that's what my previous thoughts there. But so look, to nut it out is not really to take any action. If you're long in gold stocks, well then stay long in gold stocks. If the 1720 becomes the retested resistance, that would be your first warning flag. So you've been warned at that point. Otherwise, come what may, and if the market does push up, then you really want the 1750 as the support, and in that case, you'd want this here as the arrival, the reaction, the first high above the level, an ABC pattern coming into here, and then that would be your long trade over that side here. But that's about it. I mean, we're just continuing to talk about the mess of this particular pattern here, and yeah. And it doesn't really matter if I look at SLV or the other EFTs and things. They're just the same, so I'm not getting any answers from them. I've got to get the answers from the silver. The only other place I can get it from really is the gold market at this point. Or, you know, we can look at the dollar and the bonds and whatnot, but and they're pushing up, so that's you know, more pressure on this market as well. So I mean, looking at this, it just, you know, it just looks more bearish than bullish, but at the same time, we'll just be open. Let's just keep gathering information. But the 1750 would take as support, would take the market past this top here being a wave 4. That's the reasoning behind that. And of course 5 is the second strongest number, so between 1700 and 1800, it's all about this number here, about the midpoint, the 50. And it just doesn't have it as support yet. We can give it more time, but like I say, if it slips under the 1720, well then, like, you'd need to start peeling out of long positions at that point. Not totally, but I mean, the only other thing I can think of here is looking, still a corrective move, but looking at that there, this becomes the, down here a little bit lower, that becomes the 61.8%. Because if let's just say that we've missed something totally and we're just focused on this pattern, well then this could be an A wave up here and a B wave coming down at this point here, which would only leave us with a C wave up there, and maybe a bigger, maybe even a bigger you know, maybe this 3 waves here is the leading diagonal triangle as wave 1 up there. I mean, I'm sort of going way beyond here, but, you know, ABC here for wave 1, ABC back for wave 2 here, and then a larger leading diagonal triangle to the upside. You know, that's that's sort of pushing the bar uphill a little bit. But yeah, look, we'll just see how this floats. I don't have any answers for this yet, but being long on 1750 would be hopeful and the right thing to do to the upside. And if 1720 becomes the retested resistance, then I'd start peeling out, and then you don't want to be in any trades below the 1700 here. You want to definitely be on the short side of the market. Alrighty, cheers.